This is part 5 of 7 of my stock market in-depth analysis to conclude in a detailed trend forecast for the stock market for the whole of the remainder of 2018. The whole of this analysis that includes my detailed trend forecast was first made available to my patrons who support my work. So to get immediate first access to all of my analysis and trend forecasts, then do consider becoming a patron by supporting my work for as little as just $3 per month. The yield curve inversion and the stock market. An inverted yield curve is basically when the yield on the 2-year US government bond exceeds the yield on the 10-year bond due to investor uncertainty of the near-term economic outlook, and thus investors opt to disinvest from risky assets in favor of safer long-term government bonds, thus driving down bond yields below that of nearer-term bonds. And the closer the yield curve gets towards inversion, the greater the alarm bells ring for future recession. So far, the yield curve inversion has successfully forecast the last 3 economic downturns in the United States of the past 40 years. Though the yield curve inversion has proved less reliable elsewhere, especially for Australia. So where does the yield curve currently stand? The spread between the 2-year and 10-year US bonds has greatly narrowed towards an inversion, bouncing off a low of 0.24 to currently stand at 0.29. And given the fact that the US Fed is raising short-term rates with 2 more rate hikes totaling 0.5% planned for 2018, then that can only lead to a further narrowing of the spread towards an inversion by the end of this year. So yes, the yield curve is narrowing towards an inversion, which would be a warning signal for future economic weakness, which implies trade war consequences for the United States becoming manifest some months after the yield curve inverts. However, both the yield curve trend towards inversion and the delay in impact are unlikely to become manifest during 2018, probably around spring 2019. So this does not bode well for the prospects for the stock market for much of 2019. But first, the yield curve needs to invert, which it has not done so yet. So the yield curve is something to keep an eye on, to come back to in future updates, as there is even a possibility that this time things could be different, i.e. the yield curve could just reflect Chinese economic and financial weakness as capital is finding its way into the relative safety of US government bonds, hence the narrowing in the US yield curve. And this analysis continues in part 6, which will take a look at the US presidential cycle and seasonal analysis and the economic fundamentals. So do subscribe to my YouTube channel for that video. Whilst for immediate first access to all of my analysis and trend forecasts, then do consider becoming a patron by supporting my work for as little as just $3 per month.